Have you ever wondered how bonds can enhance your investment strategy? It's a question that's crossed the minds of many, and for good reason. In the world of investing, bonds play a critical role, often serving as the backbone of a well-diversified portfolio. Why are bonds so important? Let's break it down. Firstly, bonds are a key tool for diversification. Diversification, in essence, is the practice of spreading your investments across different types of assets to reduce risk. It's the embodiment of the old adage, don't put all your eggs in one basket. By adding bonds to your portfolio, you're expanding your investment horizon beyond just stocks, real estate, or other assets you may hold. This can help balance out fluctuations in other areas of your portfolio. Secondly, bonds can act as a safety net. They are generally considered lower-risk investments compared to stocks. This is because bonds are essentially loans that you're giving to the government or a corporation. In return, they promise to pay you back with interest over a certain period. This means that barring any extraordinary circumstances, you can expect a steady flow of income from your bonds. Finally, bonds provide a consistent income stream. The interest payments from bonds, known as coupons, are typically paid regularly, often semi-annually. This predictable income can be particularly beneficial for those looking for a steady return on their investments, such as retirees. However, it's important to remember that while bonds can add stability and diversification to your portfolio, they're not without risks. Interest rate changes, inflation, and credit risk can all impact the return on your bond investments. But that's a topic for another scene. So whether you're a seasoned investor or just starting your investment journey, the importance of bonds in your portfolio cannot be overstated. They offer diversification, a safety net, and a steady income stream, all of which can help you build a robust and resilient investment strategy. Understanding the role of bonds is the first step in incorporating them into your investment strategy. So, let's continue with our journey into the fascinating world of bonds. So what exactly are bonds and how do they work, you may ask? Well, think of bonds as a fancy IOU. You're loaning your money to an entity, such as a government or a company, and in return, they're promising to pay you back with a bit of extra as a thank you for your trust. To break it down further, when you purchase a bond, you're essentially lending your money to the issuer of that bond. This could be a corporation looking to finance new projects, or a government funding public works. You, the bondholder, are promised regular interest payments over the life of the bond. This interest, or coupon as it's often referred to, is essentially your reward for lending your money. But it doesn't stop there. Once the bond reaches its maturity date, the entity you loaned your money to is obligated to return the original amount you invested, also known as the principal. However, it's worth noting that the promise of these payments is only as strong as the entity you're lending to. If the company goes belly up or the government defaults, you might find yourself holding a worthless piece of paper. Now, bonds can be an attractive investment for several reasons. They provide a steady income stream through their interest payments and are typically less volatile than stocks. This makes them a popular choice among investors looking for a bit of stability in their portfolio. However, just like any other investment, bonds come with their own set of risks. Interest rate risk and credit risk are two big ones to watch out for. But don't worry, we'll dive into these in more detail later on. So there you have it. That's the basics of bonds. They're essentially loans you give to entities, earning interest along the way, and getting your initial investment back at the end of the term. Now that you understand what bonds are and how they work, we can look at how to incorporate them into your investment strategy. So, shall we dive in? Not all bonds are created equal. How do you choose the right ones for your portfolio? When it comes to selecting bonds, there are several factors that you need to consider. Let's dive in and discuss them so that you can make an informed decision. Firstly, consider the issuer's creditworthiness. This is an assessment of the issuer's ability to meet financial commitments. Creditworthiness can be evaluated using credit ratings provided by agencies like Standard & Poor's, Poor's, Moody's, and Fitch. If the issuer has a high credit rating, it's a good sign that they'll be able to pay you back. But remember, higher ratings often come with lower yields, so you'll need to find a balance that works for you. Next, pay attention to the interest rate. This is the percentage of the bond's face value that you'll receive as income. Bonds with higher interest rates may seem attractive, but they also come with higher risk. So you need to weigh the potential return against the potential risk. Another important factor is the bond's maturity duration. This is the length of time until the bond's principal amount is paid back. Short-term bonds are less risky, but often offer lower yields. Long-term bonds, on the other hand, offer higher yields but also carry higher risk, especially if interest rates rise. Lastly, consider the type of bond. There are many types of bonds, from government bonds, which are generally considered safe, to corporate bonds, which carry higher risk but also offer higher returns. There are also municipal bonds, which offer tax advantages, and foreign bonds, which can offer diversification. The type of bond you choose should align with your investment goals and risk tolerance. Remember, investing is not a one-size-fits-all strategy. You must carefully assess your financial goals, risk tolerance, and investment horizon before making any decision. Choosing the right bonds is crucial in successfully incorporating them into your investment strategy. So take your time, do your research, and make sure you're investing in bonds that align with your overall financial strategy. You understand what bonds are, and you know how to choose the right ones. But how do you incorporate them into your investment strategy? Well, there are several strategies you can employ to effectively integrate bonds into your portfolio. Let's talk about two of them: laddering and barbelling. Firstly, let's dive into laddering. This strategy involves investing in bonds with different maturity dates. Imagine a ladder with several rungs. Each rung represents a bond with a different maturity date. As each bond matures, you reinvest the proceeds in a new bond at the highest rung, keeping your ladder intact. This strategy can offer a steady income stream and reduce the risk of interest rate fluctuations. It's like spreading your eggs across several baskets, each with a different time to hatch. Now, let's move on to barbelling. This strategy is like lifting a barbell. On one end you have short-term bonds, on the other end, long-term bonds. But notice the middle, it's relatively empty. That's right, you avoid medium-term bonds. Why, you ask? Well, short-term bonds offer flexibility, while long-term bonds tend to offer higher yields. By avoiding medium-term bonds, you can potentially benefit from both ends of the yield curve. However, bear in mind, these strategies are not one-size-fits-all. They may not suit every investor's risk tolerance, financial goals, or market outlook. So it's crucial to consider these factors and perhaps seek professional advice before deciding how to incorporate bonds into your portfolio. Remember, the bond market can be as complex and volatile as the stock market. So a well-diversified bond strategy can help cushion against market downturns and provide a steady income stream. Incorporating bonds into your investment strategy is a dynamic process that requires careful planning and regular review. So don't just set it and forget it. Keep an eye on your bond investments, adjust as necessary, and let your money work for you. Every investment comes with its own set of risks and rewards. What are these when it comes to bonds? Well, let's dive into the risks first. The most prominent one is interest rate risk. Essentially, if interest rates rise, the price of your bonds falls. This is because new bonds issued will carry a higher yield, making your older, lower-yielding bonds less attractive to investors. Now, on to credit risk. This is the danger that the entity you've lent money to, whether it's a corporation or a government, defaults on its obligation to pay you back. An entity with a lower credit rating is more likely to default, but will offer higher yields to entice investors. But it's not all doom and gloom. Bonds also bring with them some significant rewards. The first of these is regular income. Bonds typically pay interest twice a year, providing a steady income stream that's particularly attractive to retirees or those seeking a predictable return on their investment. Then, there's capital preservation. Unlike stocks, when you invest in bonds, you know the exact amount you'll get back if held to maturity, barring any defaults. This makes bonds a safer bet for conservative investors or those nearing retirement. So there you have it, the risks and rewards of investing in bonds. Remember, no investment is without risk, but by understanding these factors, you can make more informed decisions. Balancing the risks and rewards is key in making the most out of your bond investments. Incorporating bonds into your investment strategy can be a game changer. It's been a journey, hasn't it? We've navigated the significance of bonds, untangled the process of understanding them, and explored how to choose the right ones. Most importantly, we've seen how these pieces fit together in a robust investment strategy. So let's keep this momentum going, shall we? Don't forget to like this video, subscribe to our channel, and share this video with others who might find it useful. Remember, knowledge is power. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.